Welcome back. Well, if we're worried about recession, a read of business confidence may be cause for concern. Here's a look by the numbers. Small businesses in Canada are feeling slightly better about the long term. The Canadian Federation of Independent Businesses Business Barometer for March sits at 55.3, a gain of 3.5 points. The short-term confidence is lower, though, at 52.2. It did rise from February's level by 3 points. 25% of businesses say they are looking to hire. That's about equal to this time last year as seasonal hiring kicks in. But concerns about skilled and unskilled labor top the list of worries, while domestic demand comes third, with 28% of businesses citing concern about weaker outlook for consumers. Meanwhile, higher costs for fuel and energy top the list. 65% of the businesses cite that as a chief concern. And labor costs are also ranked highly. 63% say higher wages are on their list of worries. So business confidence is still moderately good, despite having plenty to worry about. What does that tell us about companies' plans in the months ahead? Andreea Bourgeois is Director of Economics at the CFIB. Thanks for being with us.
Thank you for having me.
So I wanted to start kind of big picture. Businesses, of course, have to think about the future. They make longer term plans. What kind of connection do we make between kind of their level of optimism, how they're feeling, and what they will actually put into action?
Well, the level of optimism usually influences a few things. Directly, it influences your investments, your hiring plans, expansion or non-expansion plans, depending on how optimistic you are. So there is a direct connection to that optimism level. And the higher it is, the better it is for the business. Now, you can be optimistic long-term and moderate to not optimistic short-term. Since the pandemic, we have seen a mix of optimism. Long-term has tended to be way more positive. And it's still the case. Right now, last time we measured optimism for the businesses, so end of March, as recent as it can be, optimism long-term was above short-term optimism. Both had a little bit of a bump up, which is good news, but they're still at historical levels pretty low compared to what we would see this time of the year.
And then, so we have this kind of mixed picture in terms of kind of the planning. I'm curious for your thoughts of how the employment figures fit into that. Is it a long-term optimism that makes you hire somebody? Or is it your short-term outlook that makes you think about your cash flow and maybe you hold back on hiring? Which one has the bigger influence on employment?
Well, usually long-term, and I mean, for a business long-term, you know, it's different than what is for a consumer. Mm-hmm. For a business, 3-4 months, that's short-term. Long-term would look at about 12 months. So right now, to answer directly your question, basically, it's more about short-term optimism that was driving some employment because we have a strong seasonal component. So we have a lot of sectors that are seasonal. They're getting close to their busy season. So we see employment plans being quite aggressive compared to the previous months. But at the same level as they were at the same time last year. So nothing out of the extraordinary, right, but strong hiring plans. And right now it's the short-term optimism. We see hiring, especially in hospitality, retail, construction. So all of those seasonal sectors, obviously, they're hiring.
So it's an interesting time because, of course, we have the Bank of Canada really trying to cool things off, and they're working on the consumer side of the equation. We should expect to see businesses feel that first, you would think, right? If the consumer sort of slows down spending and its level of confidence, then that would show up on the business at the till, basically. Are we starting to see that? Or is everybody kind of going on sort of concerns about that slowdown before it's materialized?
Businesses have already seen the impact of, higher interest rates and, high inflation. So a lot of the businesses, those that deal with the ultimate consumer, they are seeing lower sales, lower foot traffic in the business. They're seeing consumers shifting the way they spend the money. So this is nothing new. You'd rather buy the essential things rather than everything that you bought before. Mm-hmm. So some of the businesses are definitely affected. Businesses that deal with other businesses, they are somewhat less affected, but where they feel the pinch is in terms of high input costs, because all that inflation obviously has to reflect also in at the input stage. So those businesses, if you think especially in manufacturing, they're dealing with so high input costs, which drives their final cost to be much higher than in the past.
So we've only got a few seconds here, but when you look at the level of confidence, does this say a bad recession is on the way, or does this say Maybe mild slowdown.
Right now, we're looking for a mild slowdown. We have never talked about a recession. Yes, others have. At CFIB, based on small business optimism, we have kind of ruled the recession out for now, for the first quarter and also for the second quarter.
So good to have you with us, Andreea. Appreciate it.
Thank you.
Andreea Bourgeois is Director of Economics at the CFIB. In the U.S., the labor market has also been tight. A recent read by the Conference Board there shows that it continues that way. Its employment trend index softened slightly in March, but still at pretty high historical levels. So what does that suggest about a recession? Selçuk Eren is a senior economist at the Conference Board. Thanks for being with us.
Thank you so much for having me.
So we do have these forces that seem to conspire to keep the job markets tight. What would a recession feel like if people don't lose their jobs?
We expect a mild recession with very few job losses going forward. For the short time period, it would actually mean still a job gain, but at much lower numbers than the previous months. In a little bit longer term, let's say the third and fourth quarter of 2023, it would mean job losses, but it would be a mild one. We expect a total of around 1 million job losses over a 3-quarter time period. So that would take us to around 4.5% in terms of the unemployment rate. That is actually really low compared to the previous recessions that we have faced.
It sure is, and obviously also something central banks keep an eye on if they're keeping an eye on employment, as your central bank does. How does a recession feel completely different when the job losses aren't there? In other words, does that mean it will be a shallow recession because there aren't that many layoffs?
Yes, it would be. We expect 3 consecutive quarters of negative GDP growth, but again, a small one. Once the recession ends, let's say by the second quarter of 2024, we do expect a quick recovery in the GDP and unemployment going down and the GDP going up.
So we have these kind of historical benchmarks, Selçuk, that the banks look at and economists pay attention to. Should we be resetting them? In other words, should we have a new idea about what full employment looks like, or a new idea even of what the right level of inflation is tolerable?
Well, in a sense, I would say yes. We would have to manage our expectations. We are facing huge labor shortages. We are an aging society, so the labor pool is constantly shrinking over time, and we are playing a catch-up on that aspect. And, with an aging society, they also demand services in areas like healthcare workers, service workers, that also add to the labor market tightness. And one difference that we have in this recession compared to the previous ones is that the immigration numbers have been declining rapidly, especially during the pandemic. Now it's been back to pre-pandemic trends, but that's another reason that the labor markets are shrinking. But if the labor markets are shrinking, that means more competition among employers for workers. And that would mean higher wages going forward as well, which is going to have an impact on inflation.
That is, we don't have a ton of time, but that is a big difference between the Canadian scene and the American, right? We are bringing in tons of new Canadians. Immigration's running at record highs. Would you expect that to shift in the U.S. to more of an effort to bring in higher numbers of immigrants because of the labor market, just like Canada's done?
Yeah, it's partly a matter of policy. People do want to come to U.S. People do want to take jobs here. They are still much better paid than elsewhere in the world. So as long as the policy works, the country opens up to more immigrants, definitely.
It's great to have you with us. Appreciate your time, Selçuk.
Thank you so much.
Selçuk Eren is senior economist at the Conference Board. Coming up, is Canada running out of farmers at the worst possible time? That's still ahead. But first, iconic kitchen storage brand Tupperware has warned that unless it makes a deal with its creditors, it might be forced into bankruptcy. Hard to imagine that the company that invented a category could lose its way. But for all its inventiveness, Tupperware clung to its direct-to-consumer sales model. Think Tupperware Party, long past the sell-by date. It's not clear why it couldn't pivot to online sales like rivals Rubbermaid or Glad. What is clear is that its mountain of debt became too big for it to contain. Now Tupperware feels like the leftovers in the back of the fridge that you probably should have dealt with ages ago. We're back after this.